Florida's housing boom was never supposed to end like this. In October 2025, the state led the nation in foreclosures, while its median sale price slipped to $408,400. Start with the numbers. Nationwide, there were 36,766 foreclosure filings in October 2025, up 3% from September and 19% from a year earlier. Florida stood at the front of that wave with the highest foreclosure rate in the country, 1 in every 1,829 homes. In the Tampa metro, the pressure was even more intense. 1 in every 1,373 housing units was in foreclosure that month. At the same time, Florida's median sale price was $408,400 in October 2025, down 0.39% year over year, while the median sale price for a typical U.S. home reached $439,869, up 1.3% from a year earlier. Those four figures frame the state's new reality, a market that is still expensive by national standards, yet increasingly fragile. The underlying story stretches back to the pandemic years. From 2020 to 2022, Florida drew a surge of new buyers. Cheaper cost of living compared to states like California and New York, low taxes, warm weather, all classic magnets collated with remote work to build demand that outpaced supply. Builders responded. Florida was among the states that built the most homes over those years. By 2023, especially in Tampa Bay, that boom had a clear timestamp. It ran hot from 2020 to 2023. Then the tide shifted. Return-to-office mandates cropped up. Mortgage rates climbed. Insurance premiums in coastal markets rose. Costs tied to housing, from HOA fees to monthly payments, went up together. By 2025, the market felt locked. The share of first-time buyers nationally fell to the lowest level in history, and their median age rose to 40, a record high. Those conditions have consequences. In October 2025, Florida recorded 4,136 foreclosure starts, more than any other state. Texas had 3,080. California had 2,685. The Tampa ranking first among large metro areas with 1 in every 1,373 homes in foreclosure was magnified by a backlog of filings in Hillsborough County returning to the system. But a backlog alone doesn't explain the pattern. Something deeper changed in the way Florida households carry housing costs. Affordability tells the story. In October 2019, mortgage payments relative to income, the mortgage cost/income ratio, in Sunbelt states like Tennessee, Texas, North Carolina, and Georgia sat below 25%. Florida was near true affordability then as well. Today, many of those states face ratios over 30 to 5%. In the Rust Belt, the same ratio moved from around 20% to about 30% in states like Ohio, Illinois, and Michigan. The math is clear. Florida households are spending a far bigger slice of their income on mortgages than they did in 2019. When insurance and HOA dues climb at the same time, that extra 10 percentage points becomes a breaking point. On the ground, those numbers turn personal. In St. Petersburg, agents describe homeowners who bought between 2020 and 2023 now discovering they could sell for roughly what they paid, and then realize they might still need to bring about $10,000 to the closing table just to avoid a short sale. Once they calculate a net sheet, they're often negative. They can't sell. They can't afford the property. That's when distressed filings begin. Florida's Priceline in October 2027-5 confirms the squeeze. At $408,400, the median sale price declined 0.39% from a year earlier. Compare that to the national median at $430 N to $60, up 1.3% over the same period. The national price still climbed. Florida's didn't. Meanwhile, in Texas, a fellow Sunbelt heavyweight, the median was $341,800 in October 2025, down 0.81% from October 2024. The Sunbelt's two titans moved in the same direction: softer prices. Inventory in several Sunbelt markets has reached decade-high levels, giving buyers more negotiating power. Florida's cooling fits into that broader arc. The chain of causes is straightforward. Pandemic migration and cheap financing pushed demand skyward in 2020 and 2021. Builders delivered new supply into 22 and 22-3. By then, return-to-office orders halved the appeal of long-distance relocations. Mortgage costs climbed. Insurance costs climbed. HOA fees climbed. Each line-item mortgage interest, association dues, premiums rose, while wages struggled to keep pace. Economists warn that for retirees and those on fixed incomes, housing is a large share of spending. Small increases in those costs are felt acutely. For many households, especially those who stretched to buy during the peak between 2020 and 2023, the difference between stability and distress can be a few $100s a month. Foreclosure data mirrors that strain. October 2025's 36,766 filings nationwide marked a return toward more typical volumes. The 3% increase month over month and 19% increase year over year do not point to collapse. They signal normalization from artificially low levels. But Florida's position at 1 in every 1,829 homes shows pressures are concentrated. Tampa's 1 in 1,373 ratio reflects local conditions amplified by the timing of Hillsborough County's backlog. Analysts expect Tampa's numbers to stabilize as that backlog clears, but Florida's October tally of 4,136 starts is not a one-county phenomenon. It sits alongside statewide cost growth that includes insurance and HOA obligations. Step back to the national divide taking shape. In 2026, the U.S. housing market is poised to emphasize a contrast: Rust Belt resilience versus Sun Belt slowdown. Cities like Cleveland, Hartford, Albany, and Chicago still see appreciation supported by tight inventory and mortgage burdens closer to 30% of income. Meanwhile, many Florida markets face the opposite: higher than 35% cost burdens and decade-high inventories. The mismatched prices that remain high compared to local incomes, plus rising ownership costs, pulls demand down. In October 2027-5, the Florida median at $408,400 sat below the national $439,869, but above what many local budgets can comfortably support with current insurance and HOA costs. What does that look like in Tampa Bay? Start with the buyer-seller standoff. Owners who bought in 2021 at the height of demand thought appreciation would cover future risks. By 22-7, some learned their property would sell for roughly the same price they paid. Without enough equity to absorb fees and commissions, they face a gap, often about $10,000, to exit cleanly. Many choose not to sell. Some fall behind. With 1 in 1,373 units in foreclosure in October 2025, Tampa is where the Sun Belt correction is walking through the front door. In Miami-Dade and Broward, the dynamics have a twist. Real estate faces the same pressure: higher insurance, higher rates, higher HOAs, yet tourism hasn't retreated. The mindset has shifted. Fewer vacation home purchases, more short-term rentals. Travelers still want the beaches, dining, and nightlife, but without long-term obligations. In Hollywood, families book pool homes and condos for 2 or 3 weeks, sometimes a full month. In Miami, demand remains high for luxury villas and ocean view condos, rented, not owned. The preference is flexibility over responsibility, experiences over mortgages. That choice doesn't fix ownership costs, but it channels spending into rentals instead of second home purchases and can keep neighborhoods lively even when for-sale inventory lingers. There's another pivot point ahead. In the fall of 2025, the Federal Reserve cut rates twice. Those cuts may ease borrowing costs into 2026, but they don't erase insurance or HOA increases. Mortgage cost/income ratios above 35% still weigh on demand in places like Florida, Texas, and Arizona. In the Rust Belt, ratios closer to 30% leave more cushion for local buyers. The result? A split screen. In parts of the Northeast and Midwest, prices continue to inch up because locals can still qualify and inventory remains tight. In the South, even with Florida's median down 0.39% year over year in October 2025, buyers' monthly payments are shaped by more than just the purchase price. Take the Tampa foreclosure tally and set it beside statewide figures. Florida's 4,136 foreclosure starts in October 2025 outpaced Texas at 3,080 and California at 2,685. Those are three of the four largest states by population. Only one led the nation in rate. Florida's 1 in 1,000, 829 homes. South Carolina, Illinois, Delaware, and Nevada followed closely behind in foreclosure rates. The geography of distress now cuts across the Sun Belt and into select Midwest and Mid-Atlantic states. But Florida's place at the top underlines how ownership costs interact with hurricane risk and insurance markets. Inside the transaction, the numbers dictate the behavior. A buyer sees a $408,400 median price in Florida and asks about monthly payment. The mortgage payment reflects two fall rate cuts, but remains elevated relative to 2019 levels. The HOA fee reflects rising maintenance budgets and insurance. The insurance premium reflects current underwriting. Add those up, and the mortgage cost/income ratio above 35% in many Sunbelt states becomes concrete. The Rust Belt's move from 20% to 30% still leaves breathing room. That is why inventory tightness in cities like Cleveland and Chicago has different outcomes than inventory growth in Tampa and Miami. One crowd still bids. The other hesitates. For agents and lenders, 2026 felt frozen. Deals stalled. Buyers waited. The share of first-time buyers hit its lowest level in history. The median age of those first-time buyers reached 40. Then came October's Foreclosure Pulse 36, 766 filings nationwide, the 3% monthly increase, the 19% yearly increase. Florida's top ranking may normalize as Hillsborough County clears its backlog, but insurance and HOA costs don't reset overnight. Those owners calculating whether to bring $10,000 to the closing table still face the same budget math in November and December. The only variable is time. There is another lens, the rental pivot. Short-term rentals turn potential sellers into hosts and potential buyers into guests. In Hollywood, the appeal is quieter beaches and family-friendly streets without giving up access to Miami. In Miami, the draw is nightlife, shopping, and dining layered over cultural diversity. As fewer people buy investment condos, more visitors pick stylish apartments and ocean view condos just for a week or a month. 2 weeks. 3 weeks. Even a full month. For some owners, that cash flow bridges the gap as they ride out a slower sales market. For others, it's a transition away from traditional ownership, reducing the pool of investors bidding up prices. Now connect the dots. Florida's median price drifted down 0.39% in October 2025. The national median rose 1.3%. Foreclosure starts in Florida reached 4,136 that month, with a rate of 1 in 1,829 homes. Tampa's ratio stood at 1 in 1,373. Texas, by comparison, saw $341,800 as its median, and a 0.81% year-over-year dip. Big. Inventory in the Sun Belt hit decade-high levels. Mortgage cost/income ratios climbed above 35% across many southern states. In the Rust Belt, they rest closer to 30%. As 22-6 begins, this is the map. A Sun Belt reset, a Midwest and Northeast glide, and Florida right at the fulcrum. To understand the human side, picture the St. Picture dot at FODF7.co. Petersburg homeowner who bought in 2020, riding a wave of migration from 2020 to 2022. By October 2025, a comparative market analysis shows a sale would fetch roughly the same price as the original purchase. After closing costs, that seller may need to bring about $10,000 to the table to avoid a short sale. For a retiree on a fixed income, a 5-figure cash outlay is a non-starter. The insurance bill is larger than it was 2 years ago. The HOA fee is larger than it was a year ago. The mortgage payment, even after 2 rate cuts in the fall, sits higher than it did in 2019. The foreclosure filing becomes a path of least resistance, not a signal of collapse, just the math turning against the household. This is not universal. Some metros are trending the other way. In October 2025, Foreclosure starts fell year over year in places like Milwaukee, Indianapolis, Louisville, Washington, D.C., and Detroit. Those names line up with the affordability story. In those regions, mortgage cost burdens closer to 30% of income leave room for a down payment and a buffer for maintenance. Inventory remains tight, prices hold or climb. The contrast to Florida becomes stark when you tally the same month. 1 in 1,829 statewide, 1 in 1,373 in Tampa, and 4,136 starts across Florida. What happens next for Florida depends on three levers. The first is financing. 2 rate cuts in the fall of 25 are a start. If mortgage rates stabilize or edge down in 2026, monthly payments ease. But affordability is not just rates. The second lever is insurance. If premiums stop rising or increases slow, the mortgage cost/income ratio could slide closer to sustainable levels. The third is inventory. Decade-high levels shift power back toward buyers. In markets like Tampa, that can mean longer marketing times and more concessions. In Miami and Hollywood, it can mean a stronger shift to short-term rental income while owners wait for the purchase market to firm. The data suggests a cautious base case. Through 2026, Florida's for-sale market remains under pressure, particularly in metros with rapid 2020 to 2023 appreciation and higher exposure to insurance spikes. Statewide medians may wobble within a narrow band around $408,500 and $8,500 if October 2025 sets the benchmark. Tampa's foreclosure numbers should normalize from 1 in 1,373 as Hillsborough County clears the backlog, but Florida's position at 1 in 1,829 in October may keep the state near the top of the national rankings. Nationwide filings near 36,766 in that month, with a 3% monthly and 19% yearly gain, point to steady normalization, not a crisis. In that environment, liquidity gradually returns as first-time buyers inch back, especially if the median age of first-time buyers at 40 begins to come down with cheaper financing. The upside risk comes from stabilization in costs. If insurance premiums and HOA budgets level out by mid-2026, the mortgage cost/income ratio in Florida could drift back toward the low 30% range from above 35% today in many southern states. That shift would open the door for demand to meet the state's growing inventory. Pair that with the 2 rate cuts in the fall of 25, and monthly payments begin to move in the right direction. In that scenario, the October 2025 price line at $408,400 becomes a floor rather than a ceiling. The downside risk is a renewed cost shock. If insurance payments rise again through hurricane season and HOA dues adjust upward accordingly, owners on the margin will feel it first. Those are the households that already needed roughly $10,000 at the closing table to break even. That is where filings accelerate beyond 1 in 1,829 at the state level, or hold Tampa closer to 1 in 1,373 longer than expected. If that happens against a backdrop of decade-high inventories, sellers will cut prices or withdraw, and the Florida median could dip further below the national $439,869 line that rose 1.3% year over year in October 2025. There is a parallel to track outside the state. Reverse migration households shifting back to the Northeast and Midwest could continue to prop up the Rust Belt. With mortgage burdens moving from about 20% in 2019 to around 30% today in places like Ohio, Illinois, and Michigan, those markets appear more manageable for local buyers. Cities like Cleveland, Hartford, Albany, and Chicago have tighter inventory and sustained price appreciation. In 2026, that dynamic may deepen the divide. Florida, Texas, and Arizona focus on affordability, inventory, and costs. The Northeast and Midwest manage demand with lower relative monthly payments. For Florida's coastal markets, short-term rentals will remain a release valve. Hollywood's draw for 2 or 3 week stays, often stretching to a month, lets visitors return to the sand while owners avoid committing to second homes. Miami's magnetic pull for nightlife and dining keeps demand for luxury villas and ocean view condos high without pulling buyers into long-term contracts. As fewer investors buy condos as rental properties, more guests rent what they want, when they want, and leave the insurance and HOA calculus to someone else. That behavioral shift doesn't show up in the $408K $400 median immediately, but it supports neighborhoods that might have otherwise felt quiet amid slower sales. So where does this leave the Florida homeowner in early 2026? Start with a budget. Inventory is elevated. Buyers have more negotiating power. Prices in October 2025 were $408,400 at the median statewide versus $439,869 nationally. If you bought during the 2020 to 2023 rush, run the net sheet. If the number is negative and the gap is around $10,000, don't wait. If you're current on payments, but bracing for an insurance renewal, set a timeline. If you're considering a sale, watch the next few months for signs of stabilization as those 2 rate cuts from fall trickle through lending offers. For buyers, aim carefully. In October 2025, Florida's foreclosure starts were 4,136. Tampa's rate was 1 in 1,373. Those numbers may create opportunities, but they also tell you where the stress sits. Pair that with neighborhoods where HOA and insurance have smoothed out, and look for sellers who bought before the peak. If you're a first-time buyer, remember the big picture. The share of first-timers was at its lowest level in history in 2025, with a median age of 40. You're not late. You're entering a market many others have sat out, and that waiting may finally start to pay off if affordability improves. For investors and hosts, the pivot is clearer. In Hollywood and Miami, guests want flexibility, not mortgages. 2-week bookings, 3-week stays, full months. The rental path creates cash flow while the for-sale market recovers. If you're underwriting a purchase, use the October 2027 D medians as a baseline. $408,400 in Florida, $341,800 in Texas, with Florida down 0.39% and Texas down 0.81% year over year, while the national figure was $439,869, up 1.3%. The gulf between Florida and the nation shows where price support is firmer and where it is not. The final frame is simple. In October 2027, there were 36,766 foreclosure filings nationwide, up 3% from September and 19% from the prior year. Florida's foreclosure rate was 1 in 1,829. Tampa's was 1 in 1,373. Florida counted 4,136 foreclosure starts that month, ahead of Texas at 3,080 and California at 2,685. Florida's median sale price stood at $408,400, down 0.39% year over year. The U.S. median was $429,869, up 1.3%. Mortgage cost burdens in many southern states moved above 35%. In parts of the Rust Belt, they're closer to 30%. 2 rate cuts landed in the fall. The share of first-time buyers fell to its lowest level in history. The median age of first-time buyers hit 40. Base case, through 22.6, Florida's for-sale housing market gradually thaws from a frozen 22.5, with distress normalizing but elevated relative to the nation. Median prices hold near the October baseline as inventories remain high and buyers negotiate harder. The short-term rental market in places like Hollywood and Miami stays robust as vacationers choose flexibility. Watch 2 things closely. First, the clearance of Hillsborough County's backlog and whether Tampa's foreclosure rate falls from 1 in 1,373 toward the statewide norm. Second, the trajectory of insurance and HOA costs in coastal counties. If those stabilize by mid-year, affordability improves quickly. If they rise, Florida may retain the top foreclosure ranking even as national filings normalize around that 36,766 mark. Florida is entering a new errorless frenzy, more math. If you're planning a move in 26, set your numbers against October's benchmarks. Watch the costs that don't show up in list prices, and choose the path that lets you sleep at night. If this helped bring the picture into focus, share it with someone weighing a Florida decision this year.